Hi everybody, welcome to Chapter 16, Accounting for Income Taxes. In this chapter we explore financial accounting and reporting for the effects of income taxes. The discussion defines and illustrates temporary differences, which are the basis for recognizing deferred tax assets and deferred tax liabilities, as well as permanent differences, which have no deferred tax consequences. You will learn how to adjust deferred tax assets and deferred tax liabilities. We also discuss for the tax effects of net operating losses. In December 2017, the United States Congress passed a sweeping tax reform package. Congress reduced the corporate tax rate, accelerated the timing differences of depreciation deduction for some assets, revised how and when a company can use net operating losses to reduce its tax bill, and made many other changes. This chapter is written under the new tax rules to make sure students have access to the most current information possible. In the next few slides, we'll talk about the concepts that underpin the accounting for income taxes. In general, revenues, expenses, and losses and gains included in a company's tax return for a given year are the same as those reported in the company's income statement for the same year. However, in some instances, tax laws and financial accounting standards differ because the fundamental objective of financial reporting and the objectives of the tax authorities are not the same. Financial accounting standards are established to provide useful information to investors and creditors. Congress, on the other hand, establishes tax laws to allow it to raise revenues, as well as to influence the behavior of taxpayers. Congress uses tax laws to encourage activities it deems desirable, such as investment in productive assets, and to discourage activities it deems undesirable, such as violation of laws. An income statement and a tax return both include revenues and expenses, but differences between financial accounting standards and tax rules create temporary differences between pre-tax accounting income and taxable income. For temporary differences, the issue is not whether the amount is taxable or deductible, but when it is deductible. Temporary differences originate in one period and reverse or turn around in one or more subsequent periods. We'll walk through these concepts in the next few slides when we discuss the Watson example. Watson Associate purchases $60,000 of computer equipment in January 2021. Watson estimates that the computer equipment will have an estimated useful life of 3 years. For financial reporting purposes, Watson records straight-line depreciation each year of $20,000. For tax purposes, Watson can deduct the entire $60,000 cost in the year the equipment was purchased in 2021. For financial reporting purposes, here's 2021, 22, and 23. This is a given number. This isn't calculated anymore. You're just given that income before tax and depreciation is $120,000 each year, for a total over the 3-year period of $360,000. Depreciation straight line would reduce that $120,000 of income by $20,000 each year, so that pre-tax accounting income each year is $100,000, for a total of pre-tax accounting income for all 3 years of $300,000. The 3 years of tax returns look quite different. Income before tax and depreciation is the same as financial statement income before tax and depreciation, $120,000 each year. But the tax laws allow the company to deduct the full $60,000 cost of the equipment in 2021, leaving taxable income on the tax return in 2021 of $60,000. Because we deducted the entire cost of the equipment in 2021, there is no depreciation available on the tax return for 2022 and 2023. So the total depreciation over the 3 years is $60,000, the same that was taken in the financial statements. It's just that timing is different. That means that the taxable income per the tax return for 2021 is $60,000 and $120,000 for each of 2022 and 2023. Again, the same total. We're not changing the amounts that are subject to income tax. We're simply changing the timing of when the amounts become subject to income tax. We're given that the tax rate is 25%, which means that tax payable for 2021 is $15,000 and $30,000 for each of 2022 and 2023. And this slide simply compares what we just talked about, the financial reporting and the tax reporting. Let's first focus on pre-tax accounting income and taxable income on the tax return. Notice that pre-tax accounting income and taxable income, as I said before, are both $300,000 over the 3-year period. But these two amounts differ from each other in each of the 3 years. In 2021, depreciation allowed by the tax return is $60,000 is greater than the book depreciation amount, causing taxable income to be less than pre-tax accounting income on the financial statements by $40,000. This difference is temporary and reverses in 2022 and 2023, when Watson recognizes depreciation expense in the income statement, $20,000 in each year, but they can't deduct any more depreciation on the tax return. Now let's consider tax expense and taxes payable. We can see that Watson has taxes payable of $15,000 in 2021 and $30,000 of taxes payable in 2022 and 2023. But what about tax expense? One simple approach would be to make the tax expense in the income statement equal to whatever taxes payable on the tax return for that period and ignore any future complications of timing differences. However, that approach would not communicate to investors what Watson's current activities have resulted in future tax consequences. Investors might incorrectly think that Watson's low tax expense in 2021 and the resulting high net income will persist in the future. Likewise, investors might not realize that Watson anticipates higher taxes payable in the future. So Watson should recognize income tax expense based on the accrual concept, just like other expenses. That is, income tax expense reported each period in the financial statements should be an amount caused by that period's events and activities, regardless of the period in which the tax law indicates the tax obligation exists. If tax laws allow a company to postpone paying taxes on activities reported in the current period's income statement, the company must report a deferred tax liability. Because the company anticipates those activities will lead to future taxable amounts. On the other hand, if tax laws require the company to pay more tax than is indicated by the activities reported in the current period's income statement, the company reports a deferred tax asset reflecting the benefit of future deductible amounts. Each year's tax expense reported in the income statement includes not only a current portion related to taxes payable in the current year, but also a deferred portion that includes any changes in deferred tax assets and liabilities. The discussion of differences between accounting income and taxable income leads us to the real key in understanding accounting for income taxes. Tax expense is not calculated directly, but rather it is the result of the combination of income taxes payable and any changes in deferred tax assets and liabilities. We'll use the following four-step process to maintain that perspective throughout the chapter. First, calculate taxes payable. This is the amount of tax currently payable based on the current year's tax return. Second, calculate the ending deferred tax assets and deferred tax liabilities. In this step, we calculate the appropriate ending balances of deferred tax assets, abbreviated as DTAs, and deferred tax liabilities, abbreviated as DTLs. Third, calculate the change in the DTAs and DTLs, and I emphasize the word change. In this step, we determine the change, which will be a debit or credit, in each of the deferred tax assets and liabilities needed to move from their previous balance to the correct ending balance calculated in step 2. And step 4, plug the tax expense. In this final step, we combine the tax payable in step 1 and any change in deferred tax asset or liability accounts in step 3 to determine income tax expense. Illustration 16-1 in your textbook shows the types of temporary differences. This is a nice schedule. You should flag this schedule for future reference. Temporary differences can be classified by whether they are associated with revenue or gains, or if they are associated with expenses or losses, and whether the revenue or expense is recognized in the income statement before or after it is reported in the tax return. The temporary differences shown on the diagonal red areas create deferred tax liabilities because they result in taxable amounts in future years. The temporary differences in the opposite blue diagonals create deferred tax assets because they will result in deductible amounts in future years. Well, that's all for this video. In the next video, we'll continue the discussion of deferred tax asset, deferred tax liabilities, and we'll work with the Watson example further to calculate tax expense, deferred tax liabilities, and taxes payable. See you next time.